Welcome to Safe Option Strategies presentation of the 4 option instruments. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All right, before we dive too far into the nuts and bolts of this class, I'm going to tell you a couple of things. I want to be as clear as possible on these things, and I want this absolutely unequivocally ingrained into your mind. It is my opinion, and that's all it is my opinion, but this opinion is based on over 12 years of teaching people now how to trade stocks and options. It is my opinion that there is nothing, not one single solitary thing, more important to your success as an option trader than thoroughly, and I mean thoroughly, understanding the rights and obligations of each of the 4 option instruments. Okay. In this class today, we're just going to talk about the difference between long options and short options, but then we're going to go over each of the 4 option instruments: the long call, the short call, the long put, the short put. We're going to talk about the rights and obligations of each of these option instruments. I've created a cheat sheet for you, so even if you don't understand everything the first time going through, you'll have a reference to go back to. I don't think it's a bad idea, especially for a beginning investor, to come back and refer to this class often. Go through this class more times than just 1 or 2 if needs be. If you have a complete, thorough understanding of the rights and responsibilities of the 4 different option instruments, there is no trade, no matter how complex it is, no matter how many different expiration dates, no matter how many different strike prices you have involved, no matter how many different option instruments you're using, there is no trade that exists that you cannot understand exactly what your maximum profit may be, your maximum risk may be, and what you have to be aware of with that trade. The most complex spread trades, the most complex combination trades are easy to understand as long as you thoroughly know and understand the rights and obligations of each of the option instruments. So for starters, let's talk about long options versus short options. Anytime we refer to a long option, whether it's a long call or a long put, it equals a buy to get into. In other words, you are going to spend money to have a long option. The only way you can have a long option is to spend money on it. You will buy it. That equals a debit. That's money going out of your account. Think about your checking account. Think about your debit card. The reason they call it a debit card is because every time you swipe that card, money is going out of your account. You are making a purchase for something. Long equals buy equals debit. And when you buy something, when you pay for something, you have certain rights. When you exchange, think about every scenario in your life. When you give money to someone, you are purchasing some product or some service from that person, and you have certain rights that go with it. When we talk about short options, whether it's a short call or a short put, short equals sell. It equals a credit, and with that credit comes obligations. So if you are taking money from someone, and go back to what we were just talking about, when you give money to someone, when you give money to a store, when you give some money to your school, when you give money to a contractor that's maybe working on your house or lawn care service or something like that, you have rights. You have the right to expect them to do certain things. When you're the person receiving that money, the one giving the money to you has rights, and that means you have an obligation to fulfill whatever it is you agreed to when you took that money. So when we are short on an option, when we get a short option, we're going to get with that money, that's a credit into our account, that's money coming in, But when we take that money, we take on with it certain obligations. Here's the easiest way for me to explain it, and it just so happens that very recently my family has done a major kitchen remodel. We gutted our, and this is the second time I've done it in my lifetime. We gutted our kitchen. We took out everything. We took out the floors. We took out the cupboards. We took out the sink. I mean, everything came out of our kitchen. When we hired people to put things back in, we were the ones paying them. We had the right, every time we paid money out to them for something, we had the right to expect something in return. If we gave money to a cabinet company, we had the right to expect a certain type of cabinet to be delivered to us within a certain amount of time and installed a certain way. When we paid money to a flooring company, we expected certain things. We were the ones spending the money. We had the right to expect certain things. The contractors, the people doing the work, they're the ones that took our money. They had a credit come into them. In exchange for that, they had an obligation to perform certain services. Okay, this is all, I know this is very elementary, and it should be to most people very common sense. Apply that same common sense, apply that same thought process to option instruments, to your options. When you have a long option, you're paying money, you have certain rights. When you take money, when you're short an option and you take in the credit, you are going to be obligated to do certain things. With that in mind, we are going to go through our 4 different option instruments. Now, this page that you see in front of you right now, there is a cheat sheet on the website. If you're viewing this as a recording, it should be right below where the video is at. There should be a link that says click here to download this page. If you want to pause your screen and take a screenshot, you can do that. But I've set this up in a cheat sheet for you to refer back to as often as you need to for your long call, your long put, your short call, your short put. For the remainder of this class, we're going to go through each of these and talk about the rights or the obligations with each one of these option instruments. And I'll say it again, I want you to refer back to this as often as you need to until you thoroughly and completely understand it. Let's start with the long call. The most common used option by most people is a long call. Now, I want to circle back around, and I want to talk about one other thing. And I'm going to back up a couple screens to do this. Really quickly, there is a common thread in both of these situations, in the long or the short. And let's refer back to a moment to the contractors, the people doing the work, and the customers, the people paying for the work. Can you have one without having the other? If I'm going to spend money, someone's getting that money, right? If I'm on the side of the homeowner and I'm spending money and expect certain things to be done, I'm giving the money to someone, am I not? If I am long on an option, someone somewhere in the world is short on that same option. If I have paid money, someone has taken money. If I have taken money, someone has paid that money. The broker that you use, whoever your online broker is, they do not float these transactions. They operate simply to move the money from one individual to another. Now, they also operate to keep everybody anonymous. If I go out and buy a long call option, I have no idea who the seller of that option is, and it may be multiple sellers. I might buy 10 contracts of something, and there might be 10 different people, each selling one contract. But the only way I can buy an option is if someone else is selling it. Always keep this in the back of your mind. This is a little nugget to just tuck in the back of your mind and never forget this. When you buy an option, there is a seller somewhere for that option, or the order does not get filled. When you sell an option, there is a buyer for that option. Otherwise, your order does not get filled. Now, why is that important? It's always important to remember when we get a long call that someone somewhere out there sold that call. They're on the short call side of the long call option. When we get a long call, we buy to open it. And that means money has gone out of our account. By itself, a long call is a debit trade, and that's just another way of saying money has gone out or it's long. We typically buy at the ask price. Now, when we'll in our upcoming classes, we're going to get into more details. Again, this is why you've got to refer back to this often. In the 2 classes that follow this class, we'll talk more about strike prices, bid-ask prices. We'll talk more about expiration dates and so forth. But most often, we're going to buy this at the ask price. Here are some of the rights we have with a long call. The primary right we have for a long call is the right to buy a stock at a fixed price. We'll talk about that strike price in just a minute, for a set period of time, and that set period of time is any time. I should put in the word any time right here. We have the right to buy stock at a fixed price any time between now and the expiration date of that option. We have the right to buy that stock. The long call takes advantage of a bullish trend. Now, we also have the right, anytime before expiration, we have the right to sell that option. We're not stuck with it indefinitely. Once we've bought it, we can turn around and sell it to someone else. You might buy a house and you have the right to occupy and live in that house, but far before your mortgage is paid off, you have the right to turn around and sell that house, and you may do that at a profit as long as there's a buyer. I have the word opportunity listed here, but you have the right to do it as long as there is a buyer. The most amount of money you can lose on a long call is what you pay to be in that contract. The maximum reward to a long call is theoretically unlimited. I say theoretically because they eventually expire. If a long call expires out of the money, that makes it worthless and you lose your entire debit. If the option expires in the money, you either get the intrinsic value of the option or you may purchase the stock at that price. And in some cases, your broker can buy the stock for you. So let's give an example of a long call and make more sense out of this. Now, this is an older option chain. We're doing this class live, and it's the middle of 2017, but I left an older option chain. It doesn't matter. We're going to get a lot more into option chains and give you a lot more detail. It's really hard when we teach the 4 option instruments and then we teach working with options. It's really hard to balance which one we should do first, because it helps if you know what the bid price is, what the ask price is, what the expiration date means, et cetera, et cetera. But I think it's important that first you know what a long call is, what a short call is, long put, short put, et cetera. So we'll give more details on a lot of, if you're new to options, this is really for those of you that are new to options. I know some of you that are listening either live with me right now or that will later on be listening to this as a recording. You have a familiarity with options, and this is just good review for you, nothing more, nothing less. But for those individuals brand new to options, it'll be this class and the next 2 following it that will clarify a lot of the information on options for you. Okay, every option has an expiration date. Now keep in mind, an option is a contract. You are entering into a contract when you buy or sell an option. You're either the buyer or the seller, and it's an option contract. In the long call, you choose an expiration date and you choose a strike price, and then you see what price you may purchase the calls at. So in this case, let's suppose for a moment that this said 2017 instead of 2015. That'll make it seem a little more up to date. Let's say we're looking at an expiration date of December 2017, and we choose an $80 strike price. These are our strike prices right here in the middle. What this means is that between now and the expiration of these December options, from right now today when we buy this until the December options expire, we have the right to buy shares of this stock for $80 a share. That is what we're paying for. We're going to pay $1.45 per share right now today. Right now today, we're going to pay $1.45 per share. Let me tell you a good habit to get into right now, and we'll clarify this in one of the next classes. This column is the bid price, and this column is the ask price. So these are your bid prices. These are your ask prices. You should assume that if you're spending money, it's going to be the higher of these two numbers. And you should assume that if you're the seller of an option, if you're taking in money, you're going to get the lower of the two. Now, oftentimes, your order is filled at a price in between. We refer to that as the last price or the midway point. Oftentimes, that's the case. It's no guarantee. To be on the safe side, just to be on the safe side, assume that if you're spending money, it's going to be the worst case scenario of the two prices you see for this particular strike price and this particular expiration date. If you're taking in money, assume that you are going to get the lesser amount of the two if you're taking in money. Okay? If you make that assumption, you'll be safe more often than not. Okay, back to our long call option. For $1.45 per share right now today, I have the option to buy this stock at $80 per share anytime between now and the time it expires. Why would I do that? Why not just buy the stock at $78.05 right now today? Couple reasons. Number one, that's a lot of money to shell out right now today. That's a lot more money than this amount of money. Okay, so one reason we might not buy the stock is we don't have $78 a share to go out and buy 100 or 200 or 300 shares. But maybe we can afford $1.45 per share to buy the shares that we want, or to have the right to buy the shares that we want. And here's something very important about long calls. You're going to hear me repeat this often throughout the rest of this education. You will hear this a lot of times. Most people that buy a long call contract have no intention of ever owning the stock. With the long call, as the stock price goes up in value, this will increase in value. This amount of money that you paid for the option will increase in value. So as the price of the stock goes up, the price of the option will increase. Most people buy or get a long call option in the hopes that the price of the stock goes up and they can turn around and sell this for a profit. They're not looking to own the stock. They probably can't afford it, don't want to spend the money on it, don't want to tie up that much money in their portfolio on it. They're interested in the option going up in value. They want to buy that contract today. They want to sell it in a week or 2 weeks or 3 weeks. A very small percentage of investors ever purchase a long call option with the intent of buying the stock. Keep that in mind. Okay, we've talked about these things right here. These are for your review mostly. Okay, let's talk a little bit, just a little bit for a minute about intrinsic and extrinsic value. We're going to get more into that in one of the upcoming classes. Different companies' websites that have option chains for you to look at may display the information a little bit different, but with a call option, if the price of the stock is lower than the strike price of the option, it means that this option is out of the money. And a lot of times you'll see that abbreviated as OTM, out of the money. If the price of the stock, this is on the call side, if it's higher than the strike price of the option, this option is considered in the money. You can see here that on my broker's website, they highlight in yellow the options that are in the money versus the options that are out of the money. And you can see that on the call side, it's one direction, and on the put side, it's the other direction. We'll talk a little bit more about this when we talk about long puts, but we'll also get more into in the money, out of the money, intrinsic value, extrinsic value when we get into the next class. Keep in mind for right now that if a stock is trading for less than the strike price of your option has no intrinsic value. It is all extrinsic value. And vice versa. If the stock is trading above the strike price of our option, then there is some real value, what we refer to as intrinsic value in that option. Okay. In this situation, now, if we're like most people and we're buying this option, not because we later on want to exercise our right to buy the stock at 80, but because we want to see the value of this increase to guarantee that this is worth more than $1.45, the price of the stock has to be at least $1.45 higher than the strike price. That's what we refer to as the intrinsic value. However much higher the price of the stock is than the strike price of our option on a long call is how much intrinsic value we have, and that is what we consider real value. So if we bought these 80 strike long calls for $1.45 and the price of the stock began to move up, we have the right to buy the stock at 80 if we want. What if the stock got up to $150 a share and we said, hey, I can still buy it for $80 a share? I think that's worth doing. I'll now spend $80 per share because I have the right to do that. I went out and paid a little deposit, some earnest money, if you will, back here, and so I have the right to still buy right here. That's locked in my contract. But what most people would do is say, if the stock was trading at $150, that means there's $70 of intrinsic value, and my option is worth $70 minus this $1.45 I paid. And instead of buying the stock and turning around and selling it, I'll just sell to close this long call. And in the process of doing that, I'll make $68.55 a share. That's just the difference between the $70 and that $1.45 we paid for it. Okay, let's switch to the long put. I know you've got questions. Here's what I'm going to ask you in this class, both in the live class and if you're listening to the recording. If you're learning options for the first time, you're going to have questions about this. Some of this is going to be fuzzy, and some of this is you're going to thinking right now, Jeffrey, you're speaking a foreign language to me. I'm not understanding any of what you're saying. Finish this class. Go through the next 2 classes that talk about working with the option instruments, and then come back around and do this class again and see if it makes a lot more sense to you. Okay, long means buy, right? So now we're switching from the call side to the put side, but long means buy. That still means money out of our account. It's still a debit trade by itself. We're still going to buy it at the ask price. Instead of having the right to buy a stock at a fixed price for a set period of time, with a long put, we have the right to sell a stock at a fixed price for a set period of time. So whatever strike price we choose on our option and whatever expiration date we choose on our option, between the day we buy it, let's say right now today we buy a long put, between the day we buy it and the expiration date, we have the right to sell stock at that strike price. What if we don't own the stock? Why would you have a long put if you don't already have the stock? Well, you might have the stock, you might not. You can buy the long put contract and never own the stock. A long put takes advantage of a bearish trend. It profits when the stock is moving down. Just like with a long call, we have the opportunity or the right to sell back that option anytime we want to before the expiration date, as long as there is a buyer. The maximum risk is the cost of the option. The maximum reward on a long put is the strike price minus the net debit. I'm going to explain that a little bit more on the next page. If the option expires worthless, which means out of the money, you lose your entire debit. If the option expires in the money, you get the intrinsic value of the option. If you own stock, it will be sold away from you unless you communicate otherwise in advance with your broker. So let's talk about a long put option. Let's use our same example, and let's pretend again, since this is a couple years older option chain, let's pretend this is December 2017. I'll put a couple of 7s right there. Okay. Now we're still the buyer. Buying still gives us certain rights. Here's our bid price. Here's our ask price. Just to be on the safe side, assume that when you're spending money, you're going to have to pay the asking price. If you're taking in money, assume you're only going to get the bid price. It's a pretty big difference in this case. But if we go out and spend this $3.50 per share for a $77.50 strike price option, we have the right to sell our shares if we own them currently. We have the right to sell our shares for $77.50. If we don't have them, we still have the right to see this go up in value and to close this by way of selling to close it. Now, let me explain what I mean by this. Let's say hypothetically I had 100 shares of this stock, and let's say I had bought those shares right at this price of $78.05. Now, without this long put in place, let's make that correct. Without this long put option, 100% of this $78.05 is exposed to risk. I am 100% at risk of losing that $78.05. If something cataclysmic happened and this stock was moving along like this, and all of a sudden the stock market crashed and this went down, I could theoretically lose 100% of this. If I have purchased a long put contract for $3.50 a share, which now gives me the right to sell my stock at $77.50, it does not matter how far that stock has dropped in price. It does not matter if that stock is worth only $1 a share. I still have the right to sell it for $77.50. I paid for that right. I paid $3.50 a share for that right. Now, what if I don't have the stock? So, well, let me back up before I ask that question. As you can see, this option, the long put option in conjunction with stock ownership, in almost every way you can think of, works like an insurance policy for your stock. Imagine, think back, and I hope this is not pouring salt in any open wounds. I hope no one is still suffering the effects of this. I'm not trying to dredge up old bad stuff. But imagine, think back to Enron. If you're with me live or if you're listening on a recording, think back to whether or not you still recognize the name Enron. Enron was an oil company, an energy company based in Houston. And Enron, through some shady accounting practices, through some other shady financial dealings, through some major dishonesty by their corporate management, Enron stock virtually overnight collapsed. It became worth close to nothing. Initially, the stock took a big, giant, huge hit and dropped dramatically, and over the next few days, as news came out about the accounting practices of this company, how they were lying to their investors, how they were cooking the books and dummying things up, it just continued to drop. And it ultimately became worth nothing. And a lot of people that had shares of Enron stock got wiped out. They lost everything. But those individuals who had long put options in place, when that stock was in free fall, they had the right to sell that stock at the strike price of their long put. It worked exactly like an insurance policy. So now back to my question, what if you don't own the stock? As the price of the stock moves up, the long put option loses value. The value of this will go down. But as the price of the stock drops, the value of this option will go up and it will increase. Once the stock is trading below $77.50, it becomes in the money. And if the stock dropped to $20 a share, what's the difference between 20 and 77.50? 57.50? If the stock dropped all the way to $20 a share, this $77.50 long put would be worth $57.50. Subtract from that the $3.50 that you paid, and you've got $54 of profit. And you have the right to sell to close that long put option. Now, there still has to be a buyer for it, but you have the right to do that. Excuse me. All right. So with a long put, if you own the stock, it works very much like an insurance policy. If you do not own the stock, you can profit from the stock price dropping and the option contract itself increasing in value, and you can turn around and sell that. Now, if you own the stock and the value of the stock drops below this strike price and you go all the way to your expiration date and you don't do anything about it, your broker has the right to sell that stock away from you. They're only going to sell it at $77.50. They can't sell it for less than that, but the broker does maintain the right to sell that stock away from you if you have not already sold your contract to close it prior to you getting to that expiration date. Okay, now as I was talking, I forget that I have these little bullet points on here, so these bullet points just go over exactly what we just talked about. If you're listening to this as a recording, you can pause and look at those or check your notes on them. So that's basically where we're at. Okay. Now, when we get into short options, your mindset has to shift. With the long call and the long put, you're spending money, you have rights. You have the right to expect something. You have the right to receive some service for the money you've paid out. Now you're going to wear the other hat. Now you're going to be the kid mowing the lawn for his neighbor. You're going to be the contractor building a house for someone. You're going to be the insurance company. You're going to take money from someone, and because they spent the money and you received the money, you have certain obligations, things that you have to do if called upon to do them. Short means sell. Okay? When we sell a call, we refer to it as a short call, and that means money has come into our account. It's a credit trade. And typically, we've talked about that bid-ask price a little bit. We'll get more into that in the next class, but we typically should assume safely that we're only going to get the money on the bid price. Okay? Because we took someone's money, we now have an obligation. In the case of the short call, our obligation is to sell stock at the strike price anytime between now and the expiration date if we are called out. Now, that's an important thing. If we are called out, this is where you've got to think back to the fact that if I'm over here, I'm going to see if I can draw a stick man. Don't laugh at me too much. If I'm over here selling, I'm taking someone's money. Let's say this is our table that's sitting between me, and I'm the seller, and here's the buyer over here. You've got to think in terms of there being someone on the other side of this contract. I took this person's money. Money exchanged hands from this person to me. I have an obligation to do something, but only if this individual calls upon me to do it. Remember, we're entering into a contract. It is up to this individual to exercise his or her right to make me fulfill my obligation. Only if this individual decides to exercise their long call. For me, this is a short call. For the person on the other side of the table, this is a long call. This little table right here is your broker who's transacting all of this without me really knowing who this person is, and vice versa. But if I've got a short call, there's someone out there who has a long call. And what was their right with a long call? They have a right to buy stock at a certain price if they choose to do so. Once they exercise that right, I now have to fulfill my obligation. And they don't care if I own the stock or not. If I own the stock already, I have to sell it to them at whatever that strike price was. Let me give you an example. Well, I'll give you an example on the next page. But I have an obligation once I am called out by the person who purchased the long call. That's when I have my obligation to sell stock at a fixed price within that period of time. If I'm never called out, I never have to sell stock. And whether I have the stock or not is irrelevant. If I have the stock, I sell what I have. But, well, I shouldn't say it's irrelevant. I can get a short call whether I have the stock or not. If I have the stock, and I get called out, I'm just going to sell it at whatever that strike price is. If I don't have the stock and I get called out, I have to go buy that stock. And if I had a $50 strike price, I'll demonstrate this again on the next page. If I had a $50 strike price, I have a short call. I am obligated to sell stock at $50. And now John Doe over here says, hey, Jeffrey, I am now calling upon you to fulfill your obligation. I want to buy this stock from you. And since you took my money early on, you have to sell me this stock at $50 a share. Well, what if I don't own the stock and right now today that stock is trading at $100 a share? I got to get the stock somewhere. If it wasn't already in my portfolio, I've got to come up with it somewhere. If I have to go out and buy it at $100 a share and turn around and on the same day in virtually the same transaction, I've got to sell it to this guy at $50 a share, I've taken a big hit. I have taken a big, big loss. A short call will take advantage of a bearish or a stagnant trend. We have the opportunity to buy to close our short call anytime before expiration as long as there's a seller. I'm going to go back to that thing about having to buy the stock when we don't have it. As someone's already asked a question about it. We have the opportunity to buy that contract back before it expires as long as there's a seller. Now, this is key with a short call. As we get closer to the expiration day, the possibility of being called out prior to the expiration day increases if we are deeper in the money. Okay, go back to the example I was just talking about. Let's say there's a $50 strike price. That's the strike price of our short call. And the stock has been moving up. Here's my expiration day. And as I'm getting closer and closer to that expiration day, let's make this line the 50 mark. As I'm getting closer and closer to the expiration day, stock just keeps on going up above, keeps on going up above. And the closer I am to the expiration date, and the farther the stock price is above the strike price, a combination of these things right here increase the possibility that I get called out early. But I want you to think back now for just a moment to what we said about long calls and how rare it is for people to buy a long call with the intention of buying the stock. In most cases, this is my short call that I'm worried about. I'm worried about the fact that it's going over $50 a share and it's getting closer to the expiration, but we've got John Doe over here who's got his long call. It's my short call is his long call. And as we get closer to the expiration date and this stock continues to move up in price, he becomes more and more likely that he is going to sell this long call rather than exercise it. He's not going to call upon me to go out and buy stock. He's going to look for someone else that wants to now buy this from him. They're going to take the contract off of his hands, and he's going to make his profit that way. But eventually someone, if he's successful in selling this to someone else and they're successful in selling it to someone else and they're successful in selling it to someone else, eventually this gets closer and closer to the expiration and I'm either got to close it manually or I will get called out. So the closer I get, the more the chances are that I get called out. Being called out early, and by early, I mean prior to the week of expiration. All options expire on Fridays. If this is the previous Friday and this is the previous Friday and this is the previous Friday, getting called out in here is incredibly rare. It's not that it doesn't happen, but it's rare. Once I get into this week of expiration, Monday, Tuesday, Wednesday, Thursday, once I'm into this week leading up to the expiration date of that option, my chances of getting called out early start going up dramatically if the stock is trading higher than the strike price of the option. Okay, assignment will be automatic at expiration if the option is in the money. Something you have to know about short calls. Okay, we talked about if you own the stock already and you have a short call and the buyer of that option calls you out early, they get to buy your stock from you. You already have the stock, so you're probably okay. If you didn't have that stock already and you had a short call in place, that is referred to as a naked call. You've probably heard, even if you're new to options, you've probably heard some reference before to naked calls. When you have a short call and you do not have the stock ownership or a long call to go with it, and that's getting way ahead. We'll get into that when we start teaching the spreads. But if you don't have the stock or the ability to buy the stock at a certain price, you have a naked call. A lot of brokers will not allow you to write naked calls. A lot of them just won't do it. But if you have a naked call, you have unlimited risk with very little profit potential. I'm going to say this right now. You'll probably hear me repeat it a few times. Stick this in your mind and don't ever forget it. Never, ever have naked calls. Do not trade naked calls. There will never be a time when it is a good idea to have a naked call. I'm going to share a real quick story with you. If this individual is listening to the recording, or if he's, I don't think he's with us live right now, but if he's listening to the recording, I have his permission. I'm not going to tell you his name anyways, but I have his permission to share this story. One of my earliest students, and this goes back a lot of years ago, one of my earliest students loved to write naked calls. Stock would be going along like this, and he would write a 1 or 2 week out naked call, and it would expire, and he'd get a nice credit for it, and then the stock would go like this, and he would do another naked call, and it would expire, and every time he took in a credit on one of these naked calls, he profited. But every time he wrote one of these naked calls, theoretically speaking, he had unlimited risk. He had a naked call in place one day. Some news about the company that he had that option in place with came out overnight, unexpected. There wasn't a set scheduled news conference. There wasn't a scheduled event. There was some news that broke overnight. When the stock opened in the morning, it was way, way above the strike price of his short call. Okay, I'm not making this up. I'm not exaggerating this. On a $100,000 account, his naked call in one day cost him $70,000. He lost 70% of his account in a day. Don't trade naked calls. If you're ever going to use a short call, because this is unlimited, and we never want to be in that situation. If you're ever writing a short call, you're either going to have stock, all that you already own, or you're going to have a long call that gives you some protection, and we'll teach that when we get into the spreads. Okay? Here's how a short call works. Let's say hypothetically I already owned shares of SanDisk at 78.05, and right now today someone is willing to pay me 51 cents per share for the right to buy stock from me at a certain price, $80, for a certain period of time, for the next 53 days until expiration. That's my short call that is covered by owning the stock. So I get paid right now, but if that stock moves higher than 80, remember, for me it's a short call. For the guy on the other side of it, it's his long call, his or her long call. All right? If they, at any point in time, choose to exercise their right to buy at 80, I have to sell at 80. I have no choice. Once I took their money, I have to sell at 80 if they call upon me to do so. If I already own the stock at 78.05, that's okay, because I get to sell it at 80 and I get to keep the 51 cents a share. I made out really well. If I don't own that stock and the price of that stock begins to go up, yeah, I keep my 51 cents a share. But what if the stock, let's be more realistic and not give such an exaggerated example. What if I don't own the stock? I take 51 cents a share from someone and I'm obligated now to sell them that stock. That's what the short call does. It obligates me to sell that stock. And by the time they're ready to proceed, the stock's at $85 a share, and I have to sell it to them at 80, but the only way for me to get my hands on it is at 85, I'm taking a $4.49 per share loss. That's an awfully big loss for such a little bit of potential reward. Okay? That's how a short call works. Let me clear all my hinge scratches off of there. And now you can look at those bullet. I keep talking ahead of my bullet points. Okay. Last but not least, the short put. Again, we're going to sell to open it. Money is going to come in. We have an obligation. We take in a credit. In exchange for that credit, we get an obligation. Expect to get the lower of the two prices. The bid price is always lower. The ask price is always higher. Expect to get the lower of the two. In this case, we have an obligation to buy stock. We don't have an obligation to sell the stock. We have an obligation to buy the stock. What happens with a short put is that if we take money from someone and they exercise their right to sell stock, whether they have the stock or not, they exercise their right to sell it, it is put to us. That's the terminology that you'll get accustomed to. That means it's early assignment. It means the stock is being put to us. Whether we want to own that stock or not, we have to buy it. For me personally, one of the easiest ways to think about a short put, go back to the long put for a moment, and if we own the stock already, isn't that kind of like an insurance policy? We already established that, right? If we own the stock and we have a long put, it's like an insurance policy. Well, I'll see if I can draw it again quickly. Here I am. I'm going to ask this question to you. See if I can draw a table again. You can tell I'm not an artist, but I'm trying. Okay. So we've got money transacting this way. This individual is paying me money. He has the long put. What did we say that long put is like? I know it's a real rhetorical question. In many ways, especially if we already own that stock, that long put is like an insurance policy, right? Who do you pay for your insurance policy? Do you pay your neighbor for your insurance policy? Do you pay the grocery store? I'm being a little facetious. Do you pay the grocery store for your insurance policy? Do you pay the contractor working on your house for your insurance policy? No, you pay the insurance agent. And what is in exchange for taking your money, what does the insurance agent have an obligation to do? No, he doesn't necessarily have an obligation to buy your house, but if your house is destroyed by a meteor falling on it, he's going to have to pay for the house. Isn't that kind of the same thing? Kind of. If we're taking someone's money and opening up a short put, we are simply playing the role of the insurance company. If something happens and their stock drops in value and they say, oh good, I had insurance on it, Mr. Insurance Agent, pay up. Well, how do we pay up? We have to buy their stock, and we have to buy it up at the price or the value of their insurance policy. So if they had a $50 a share stock and they bought an insurance policy for $50 with their long puts, and they're probably only going to pay $1.50 for this. Let's say hypothetically they pay $1.50 for their insurance policy. Well, if the stock drops down to $20 a share, guess what? They can sell it all to us for $50 because they bought the right through their insurance policy to do that. A short put would work in our favor, just like with the insurance agency. If you think of a short put like you being the insurance agent, what does the insurance agent want to have happen? They want the value of that property that is being insured. They want it to stay level or go up. If we're talking about homeowners insurance, and I'm the insurance company, I want the value of that home to remain the same. No damage is done to it. Maybe the market isn't great, but no damage is done to it. There's no flooding. There's no earthquakes. There's no tornadoes. There's no drunk drivers driving through the front door of the house. The value of the house stays flat or it goes up. Then when the policy expires, the insurance company has just kept your premium, and they made money that way. What they don't want to see is something that causes the value of the house to go down. A flood, a fire, a tornado, an earthquake, whatever the case may be. In the case of options, we're playing the role of the insurance company, but it doesn't matter what causes the value of that stock to go down. If the guy who bought the insurance policy, i.e. the long put, wants to exercise his right, he can force us to buy that stock at that fixed price anytime between now and the expiration date. So if the stock remains bullish or even flat, we make out great on a short put. Just like with the short call, we could buy it back anytime as long as there's a seller. Now, unlike the short call, we told you that the short call prior to the week of expiration, early assignment is unlikely. It's possible, it happens sometimes, but it's not real likely. Not the case with a short put. When a short put moves in the money, in other words, the price of the stock moves below the strike price. If this is that $50 strike price, the value of our insurance policy, and the stock has now moved down to $47 a share, we need to assume that at any time, we could have that stock put to us at $50 a share. It is more common, it is more frequent with short puts to get early assignment than it is with short calls. Now, why is that the case? Why would it be more common with short puts? Early assignment. Think of the other person on this. Think of the person on the other side of the transaction. Think of the buyer. The guy who is buying, the guy or gal, I don't mean to be sexist, I'm sorry. The guy or gal who's buying the long call, more often than not, has no intention of ever owning stock. They have no desire to own the stock. They buy that long call because they want it to be profitable and they want to turn around and sell it to somebody. The person who buys the long put, oftentimes they are protecting their investment of stock with a long put used as an insurance policy, and there is a much greater chance that once that stock starts dropping, they say, whoop, I'm out. I'm going to give it to the guy that took my money earlier. Guy took a couple dollars a share from me so that I could dump that stock at 50, and that thing's going down, and I'm a conservative, maybe a little bit of a fearful investor. I'm getting out. And they don't care how close it is to expiration date. Now, there are plenty of people that buy long puts to see them get profitable, and they have no intention of selling stock because maybe they don't own the stock. It is much more likely with short puts to get early assignment than with short calls. Maximum risk here is the strike price minus the credit. Now, this is different. With a short call, there's unlimited risk to the upside, because there's theoretically no limit to how far a stock can go up in value. With the short put, however, there is a limit to how much you can lose, because the stock could only go to zero. If I took in $2 a share, and remember, I'm playing the role of the insurance company now. I took in, this is money in to my pockets. I took money in of $2 per share. I have an obligation now to buy stock at $50 a share. Well, the stock can only go down to zero. If the stock goes down to $1 a share, and that's when the person says, hey, Mr. Insurance Man, I'm going to call it in. I'm going to make you pay me $50 a share for my stock now. And now I own a stock that's only worth $1, but I just had to pay $50 a share for it. I get to keep my $2 credit. So the worst case scenario is that stock does go all the way to zero. I'm out $50 a share because I had to pay $50 for it, but I did keep the $2 credit. That's mine no matter what. My maximum loss is $48 a share. And that is the difference between the strike price and the credit you took in. In this case, that's $48. That's the most you could lose on that. Naked puts come with a very, very high risk, but unlike a naked call, they don't come with unlimited risk. I will tell you, it is very, very rare that we will ever use naked puts. When we get to some strategy things, we will show how on a rare occasion, on a very rare occasion, a naked put could be used as a means of getting into stock ownership, but only in a situation where you were intent on owning the stock anyway. Of course, the maximum reward is whatever credit you take in. So if we went out and took in 55 cents per share on a short put, we have at 77.50 strike price between now and the expiration date, we have an obligation to buy stock at 77.50. Okay. If the stock is trading above 77.50, our short put expires with no real value in it. We keep the 55 cents. We are no longer in our obligation. We are done with it. If the stock is trading below 77.50, we have real intrinsic value and we are at risk of having that stock put to us for 77.50 a share. We have to buy it no matter how far below 77.50 it is. We took on an obligation to buy that stock at 77.50. There's a lot of risk, not unlimited risk. Okay, I'm going to refer back to this. These are basically the bullet points that were on each one of these, what your rights and obligations are with each one of these option instruments. I've color-coded them to indicate which ones benefit from a bullish move, which ones benefit from a bearish move. Little bit of information about intrinsic and extrinsic value here, but we'll go a lot more detail on those as we go into the next two classes. And like I said, I would encourage you to view those next two classes, then maybe come back and review this one if you're new to options. If you're an experienced option trader, somewhat experienced option trader, little bit experienced option trader, this is just hopefully a good review for you. Learning these rights and obligations will do more for your understanding of spreads and collars, more for your understanding of risk and reward, and more for making you a profitable trader than any other one thing you will learn. No matter how complex the trade is, if you understand thoroughly your rights and obligations of the option instruments you are using, you'll be okay. You'll know what to expect. That wraps it up, folks. Thank you very much for participating in the class today. If you were here with me live, if you're listening to a recording, on to the next class. Thanks. Bye-bye.